Hi, this is Raghee Horner, and I'm coming to you from a Monday afternoon, just after lunchtime. I'm taking a look at the Euro US dollar on a day that the Dow is up triple digits. At last look, it was, about 192 points up. And so we're looking at a day where, during lunchtime, we're hanging on to almost a 200-point gain in the market. We'll see what the remainder of the day brings, but I think it's very interesting to look at how today's risk appetite is affecting certain markets, and in particular I want to talk about the Euro US dollar, and in that light also discuss directional bias. So we've got the backdrop of a lot of risk appetite. I think a lot of people are breathing a sigh of relief that the storm, Hurricane Irene, didn't do more damage than it did. Certainly I'll be very interested to see what happens as the bonds close at 3 p.m. Eastern Standard Time, and what the market will close at, because we all know the market can do whatever it wants throughout the trading day, but it really only matters what happens at 4 p.m. and what the Dow closes at. That is the psychological proof of that risk appetite or risk aversion as the U.S. trading session for equities winds down. Now, why so much talk about equities? Well, we look at what equities do to the dollar, to commodities, to crude oil, to gold. How many of you looked at what happened to gold today? Last time I looked, gold was down $30. It's been due for a correction. We are correcting the uptrend. I don't question that people will step in and buy gold. There's still a lot of speculative activity going on there, but certainly trading lower is a reflection of the risk appetite. What else is a reflection of the risk appetite? The dollar's being driven lower. It's down through 74 on the US dollar index again, and that's worth mentioning. And also, I think it's also worth mentioning that crude oil is up higher, and that move up higher in crude oil has, of course, the strength there is the fact that the Dow's up higher and that the dollar is down lower. So it's a 1-2 punch there, where a cheaper dollar, a weaker dollar, equates into higher commodities prices, and that weaker dollar is sometimes caused by what we're seeing today, the stronger equities markets here in the U.S., and that also is able to carry up commodities like crude. Now, all that is on the backdrop of what I'm talking about here on the Euro US dollar. The Euro US dollar is having a pretty good day. Risk appetite usually helps the Euro US dollar. That US dollar weakness, and I should say the Euro US dollar, the risk appetite helps the Euro US dollar, and that risk appetite also weakens the US dollar index itself. So all those relationships are really important to understand, because it gives us an idea as to who and what is driving the market, and if that driver, if the trend or the strength, the momentum reverses, we understand what it might do. It's really important to know what's driving the market. Is the dollar weakness a symptom of anything other than the Dow Jones strength today? I really don't think so. In fact, the dollar is just hovering near its range lows, just as the Euro US dollar is hovering up near its range highs. And this is where I think we could start to see a little bit of weakness start to build. So what I want to do is I want to insert the stochastics oscillator here on like a fairly slow setting, as you can see. And what I want to see is whether or not we're entering that overbought territory, which it seems we are. I am more interested in whether or not we're above 80 or below 20 than I am all the random crossings. Okay, I'm much more interested in, and really, if I want to even simplify it to a greater degree, there's no reason we can't do this. Again, I'm more interested in the location. So again, here's a little bit bolder a look. Okay, and here's even a more simplistic look. And for traders of stochastics, using a stochastic this would be like sacrilege to essentially eliminate, here we go, the main line, the smoother of the two. I'm just interested in whether or not we're overbought or oversold, because it's the environment that I'm interested in. I will allow price to actually trigger my entry. So it's really about whether or not I'm going to exhaust. And let's look at it for a moment. think about what's going on here in terms of the past resistance. Okay, I could look at, let's take a look at the areas back here. I could take a look at the, bear with me, I could take a look at, let's say for example, this high back here. I could take a look at this high back here. These highs have already been challenged to a degree where I think they've been broken, but now the question is whether or not at this point in time, and this is the power stats right here, whether or not we're going to reach that high and consider what it means in these past highs. Could it be that as we are looking at this overbought reading and looking at this area right here, could it be that we're going to start to exhaust? Well, I want to allow price to give me that insight. Now, any kind of fade, okay, think about these past highs here. You can even drop some vertical lines. We're looking at a past high here. Let's go back to that peak. Past high here of, let's see, this is 45.72. I could definitely drop a horizontal line across that. 45.72. There we go. How about this line right there? We have a high waiting here at 45.34. Again, I'll drop a line there as well. 45.34. And put that into context of where we are right now. And these two previous highs are basically sandwiching what we're getting right now. Today's high is currently, we're far from done, but today's high is currently 45.49. So we're inside this zone here. Okay, so this zone of resistance, or this layer of resistance, is where we might see the exhaustion occur as the stochastic is, as you can see, in that overbought area. Now some of you might want to say, well, that's great, Raghee, but I like having both lines. That's fine. Part of your confirmation may then be when there's an actual crossing, but notice you've had a lot of crosses before. It's not just about the cross, is it? It's about where the cross is occurring in relation to the 80 and the 20, and more importantly, where it is in relation to where the market could actually, from a price standpoint, exhaust. So why am I looking at exhaustion? Well, this has to do with the directional bias that I mentioned at the onset of the video here, which is the euro US dollar actually going anywhere in terms of having a dominant trend? It is not. There is no clear bullish or bearish psychology. We do get bursts of bearish momentum, bursts of bullish momentum, even neutral momentum, but there's no trend here. And in order to trade, in my opinion, in order to trade a pair on a longer term time frame, intraday, like a 60 or 240, it's easier to have the trending market as the backbone of determining what the dominant psychology is. If not, I'm just looking really for a fade here. What I'll look for is what I call my distribution fade. And when I say distribution fade, again, what I'm talking about is that combination of the overbought indicator. So really, it's in this case, we're talking about the market being overbought. All right, just get some notes here. So we're talking about the market being overbought. How do we measure the overbought? We measured it by not just, price obviously is always going to be a major issue. And then of course down here, I removed it, but we also have the stochastic. And we want it above the 80 level, right? So it's that combination, but it's the environment here. It's the fact that I feel that we are in that sideways range as confirmed by the 34 EMA wave. And then you can see I measured overbought by price, number one, and then I confirmed it with the stochastic, number two. The only reason I'm even considering a distribution fade, and again, it's in this zone, in this layer here of resistance. We have this layer of selling pressure here. The reason I'm considering it is because a 34 EMA wave is going at what I call a 2 to 4 o'clock angle. 2 to 4 o'clock angle. And most often you'll hear me refer to this as distribution. So when I have a lack of a dominant bullish or bearish psychology on the end of day chart, consider what that's going to do to the intraday time frames. And frankly, what I'm going to do then is focus on shorter term time frames, 5, 15, 30-minute time frames. I'm really likely not to consider the 60 or the 240. Okay, and even more so, like see this 60-minute chart right here? In and of itself, the angle is probably, in terms of clarity, the best one out of my time frames that I trade. The 60-minute actually looks the best in terms of clarity. And when I say clarity, what am I referring to? The clarity of the 34 EMA wave is dependent upon a few things. Okay, so when I talk about clarity, I want you to understand that there are some issues that I'm talking about. One, this is all predicated upon actually having a wave angle that is easily identified. I think this 12 to 2 o'clock angle is easily identified. So now I want to think about, from the aspect of the indicator itself, is it smooth? Okay, I want to consider, is it established? In other words, in terms of how long has it been traveling at that 12 to 2 o'clock angle. And if there is a trend and it's been corrected, we have seen it here, is the 34 EMA wave respected as dynamic support or resistance? In this case, we're talking about it behaving as potentially dynamic support. So notice some of the past pullbacks. This is what I want to see. We haven't had a lot of corrections, although this isn't a very long-term uptrend either, but this is what I want to see. However, because the daily time frame lacks a dominant directional bias, this is a slightly longer-term intraday time frame. And when I look at the daily, two things occur to me. One, I'm in an area where I could actually exhaust and possibly dip substantially lower back into the range of the daily time frames channel, or whatever you want to call this. Really just, it's slop, isn't it? Now I do need exhaustion here. I do need it to come back to the wave, which it has twice already. I would consider this an aggressive trade at best, or would not consider it at all, because this could be where the buying support steps away and we're really looking at possibly a much slipperier slope for Euro US dollar bulls. So that directional bias in the most extreme situation is going to eliminate this 1 hour chart from my potential trades. And the alternative is it's going to put me in a much more heightened sense of awareness that, yes, we don't have a dominant bullish psychology here. So my assuming that traders will want to step in at a longer term time frames support level should not be a given. I should not assume that at all. Okay, and therefore, if nothing else, I'll be a little bit more cautious, maybe smaller position sizing, maybe slightly more aggressive, keeping a closer eye on it as we've triggered what would be a swing buy for those of you that are willing to take it. If not, you focus on the short-term time frames. You focus on the fact that we could actually begin to reverse, in which case I could look at, say, the 30-minute time frame, put up an indicator like the MACD histogram, which I want to use a signal line. That would be on this platform called the moving average oscillator. Okay, or I could pull up an indicator like the CCI, the commodity channel index. I like it on a 20 period setting. I could use either one of these, and if and when prices can break the 34 EMA low, okay, this moving average here, 34 EMA low, if they can break it, I want to look to make sure the MACD is negative, and or I'm getting a negative 100 or greater reading on my CCI. That would be a wave reversal, or a wave CCI reversal. Okay, so again, my hesitation for getting too bullish on the 1 hour comes from the lack of a directional bias on the daily time frame and that 2 to 4 o'clock angled wave.